Alli, I'm just going to ask you a sort of an overarching question of whether we will see new highs or whether you feel like U.S. markets are getting to the top end of a range here. Because we've had, since the beginning of the year, it's been a great move, like almost a historic move, snapback from those December 24th lows. Is it getting tired, or do we go through the old highs?
So I think we still have room to go. I'm not going to say that we've hit bottom or, there are different highs to come, but I think we're still constructive on the U.S. market. We definitely see some slowing, maybe even some negative earnings growth in the first quarter, but we see the second quarter taking off. And, I think, in the last 5 bull markets, we have seen periods of sort of earnings stabilization, and then we've seen growth. So in the last 5, you've seen 15% earnings expansion before and 20% earnings expansion after. And I think that what we have to remember is we've been in a really long, really a Boolean bull market. And, now we're getting to normalization. And so I think you're going to have the same thing we've seen for a while, which is you're going to have volatility persisting. And we're going to continue to be in this sort of February Groundhog's Day of every day is going to be a reflection of where do we think we are in Chinese trade talks.
Well, did you just say you're not sure the lows are in?
I hope the lows are in. I hope the lows are in. We definitely think there's a greater chance of a lot of upside than a lot of downside.
We're like 15% off the lows, aren't we, at least?
Yeah. I mean, look.
You think it's possible we, at some point this year, go back to the December 24th levels?
I hope not. I think it's probably more a tail risk than anything else. But if you start to have concern around the 3 big things we've been seeing, if you see the Fed, instead of taking the dovish and supportive stance it has, if you see them looking at data that they don't like and it backs off a little, I think then you might be in trouble. If you start to see some of the rhetoric around trade extend to autos, so you start to get Japan, you start to get Europe, you start to get the commissioner of Germany involved, then I think you're in trouble. But I think we're in for a period of 4% expansion and normalization here. But again, we're late cycle, so you're going to see more volatility than we've seen over the last 11 years.
So Alessio, you don't like Europe much. You would know, hopefully. You're underweight there, modestly overweight here, but emerging markets look good again?
Yeah, so we continue to see Europe as showing the weakest cyclical dynamics. We think the U.S. will continue to lead on a relative basis in global equity markets. And for emerging markets, we have been positioned overweight at the turn of the year and into January. We have now scaled that overweight back to neutral. Why is that? Because there's been a big disconnect between the rally that we've seen in the first 6 weeks of the year globally and the weakening of the data. The economic data has really deteriorated globally, but in emerging markets in particular. If you start looking at some of the manufacturing surveys, the PMI surveys, we have printed sub-50 readings, i.e. contractionary readings, in several key cyclical economies such as China, South Korea, Taiwan, and if you go to developed markets, Germany, Italy. So this disconnect between rising equity markets and weakening fundamentals bears watching, and some of the places where we're most worried is Europe.
China is one of the best performing markets in the world so far this year, shockingly, even though the data has been continuously weakening this year. In terms of Europe, we've seen that too, that we've seen that sort of strong bounce for this year in light, in the face of weakening data. So at what point would you say, or if you ever would say, that stimulus from central banks around the world will actually help fuel these rallies? Because the ECB just coming out saying that it's going to go back to helping bank lending, basically, with another program.
I think you're hitting the nail in the head. This rally was fueled, obviously, by oversold conditions that we saw into December, and the 2 catalysts for the rally were dovish turn, primarily by the Fed, the ECB, and the stimulus from China, as well as constructive trade talks. Now, the ECB really cannot do much more, right? The second round of TLTRO, so easing of financial conditions, is in the cards, is priced in, but the ECB cannot really bring on the bazooka anymore. No more credit easing. Quantitative easing is very difficult to deliver at this stage, as Draghi will retire in October. It will be difficult for the Council to develop enough consensus and bring on more stimulus. So at this stage, after this rally that was driven by expectations and stimulus, we need to see the data validate that. And usually the data lags the policy impetus by 6 to 12 months.
So right now, your biggest overweight is U.S.?
So in global equities, yes, we favor U.S. equities at the expense of European equities, and we're neutral on emerging markets.